clearly, I mean, we have seen this data around, right? The US is probably seeing the sharpest ever contraction in GDP it has seen in the last 50, 60 years, as the red line or the chart shows. And even coming back is going to take it at least 3 to 4 quarters, for it to really start coming back. The picture is no different as far as India is concerned. We are seeing that GST collections saw a V-shaped bounce back, but that is because it's a little misleading because there were 2-month figures which were bunched together, for the month of June. Manufacturing PMI is clearly showing you, and generally speaking, PMI data is an indication of what's the state of the economy, what's happening on the manufacturer. Any PMI over 50 is regarded as decent, not good, mind you, but decent. And we can clearly see that the PMI data are showing that we are operating at a bare 50% of our capacity. So is the services PMI. Services has been the backbone of this economy all these years. Unfortunately, the lockdowns and the subsequent events have resulted in a huge chunk of that economy, whether you talk in terms of the airlines, whether you talk in terms of hotels, whether you talk in terms of restaurants and other such small businesses, seeing immense pain and continuing to see pain at the present moment. So what has the government and the Fed done? Well, in the US, they virtually took out a bazooka. And you can see that. You can see that the money supply numbers have just gone up like a hockey stick. The Fed has expanded its balance sheet absolutely dynamically. Well, they can do this because they are the developed economy. They are the economy which has the currency, which is the reserve currency of the world. The net result has been that bond yields have come down to near zero. These are absolutely unprecedented times. When you see this kind of bond yield, you clearly see that alternates for people to put their money is reducing more and more. A very similar picture, while the government stimulus has not yet come, we've seen the RBI do its bit and come up with stimulus, liquidity. And one of the first few things that they did was they tried to address the fear in the system that seemed to prevail and the panic by flooding the system with enough and more liquidity to see that there is no collapse of the system. I think they've done a commendable job. There has been almost a 70-80% retraction in terms of the yield difference between AAA and even below as such. The difference was huge. That has come down. Net result has been interest rates have come down again. And it is significant from a perspective that if you consider that if 2 years ago you were retiring and you had your wealth lying in a bank or in certain fixed income earning about 8%, and maybe in corporate bonds earning 10%, suddenly now you're seeing that same bank is only paying you 4.5% and 5% and so on and so forth. So it dramatically changes the way you are going to live your life. And that is causing huge changes in asset allocation. But net result has been, you can see in the last 3 months, there's been almost close to $5.25 billion of inflow from FIIs. The domestic institutions continue to pump in money. So if you really see what has happened is globally, banks and governments in places have pumped so much of liquidity and cheap liquidity into the economy. This has really made the markets delirious. This cartoon kind of sums up the state of the markets. It's yet seeing stars with the kind of steroids that the Treasury and the Fed have pumped in. And, net result, from the lows of March, you have seen a recovery which has been unprecedented. The kind of bounce backs that you've seen, whether it's the NASDAQ, whether it's the Dow Jones, whether it's the DAX, whether it's the Kospi, Nikkei, and our own Nifty, and so on and so forth. So while the correction was 38% from the bottom, to the bottom. For the Nifty, it was almost in line with all the rest. The bounce back has also been very, very sharp. As a result, we are barely around 8 or 9% away from the peak that we saw in January as such. In a nutshell, if you were to ask me why the market's going up when the economy is down, it is pure liquidity chasing stocks. It's pure lack of alternatives, because if you ask anybody, they're only seeing two areas where they can go and put their money to be safe. So some people are going to gold, some people are going into equities.